The Indian government has unequivocally stated, long-term and short-term capital gains taxes are here to stay. This isn't just a fleeting headline, it's a structural confirmation that reverberates through every corner of the world's fastest-growing major economy. For sophisticated investors, this signal forces an immediate reassessment of India's investment framework. It challenges the conventional wisdom that tax regimes are always fluid, especially when significant revenue streams are involved. Our goal today is to dissect what this fixed policy means for the Nifty 50 and Sensex, and how institutional capital will likely adapt. Now, let's look at the immediate financial implications for the broader market, which acts as our quarterly results in this context. While the Nifty 50 and Sensex have shown remarkable resilience, the confirmation of these taxes presents a fresh challenge, particularly for foreign institutional investors, or FIIs. They're often seeking optimal after-tax returns globally. The immediate implication is a potential recalibration of investment theses for funds sensitive to capital gains, translating to either reduced fresh inflows or, in some cases, a trim consideration for existing positions where other markets offer better post-tax arbitrage opportunities. This isn't a market crash, but a re-evaluation of relative value. But that is only part of the story. Here's where domestic flows become critically interesting. We've witnessed a structural momentum shift with domestic institutional investors, or DIIs, providing a robust counterbalance to FII movements. The sheer volume of systematic investment plans, or SIPs, from retail investors continues to funnel consistent capital into the Indian markets. This demand recovery from domestic sources acts as a significant liquidity buffer, often absorbing selling pressure from foreign investors. So, while FIIs might be rethinking their approach, the deep pockets of Indian household savings are insulating the Nifty and Sensex from more severe volatility, painting a picture of resilient underlying demand. The next signal comes directly from management's capital allocation, or in this case, the government's fiscal priorities. The official statement makes it clear, capital gains taxes are a crucial, stable revenue stream. This isn't an oversight or a temporary measure, it reflects a deliberate policy choice prioritizing fiscal stability and funding for ambitious public infrastructure projects and social programs. This policy tailwind for government spending means these taxes are baked into the long-term budget. From a portfolio manager's perspective, this isn't just about revenue, it's about signaling a clear, consistent approach to economic management, even if it creates friction for some segments of capital. Now look at how the broader sector is reacting, placing India within the global competitive landscape for capital. India's structural growth story, driven by demographics, digitization, and domestic consumption, remains incredibly compelling. The country consistently posts robust GDP growth, making it a standout in a challenging global environment. This foundational strength often overshadows specific tax concerns for long-term strategic investors. However, highly mobile global capital constantly compares India's risk-adjusted returns against other emerging markets like Vietnam, Indonesia, or even parts of Latin America, where tax incentives might be different. It's a nuanced calculation, balancing strong fundamentals against policy friction. This leads us to a bigger question regarding terminal risk, the risk repricing effect. While the taxes themselves aren't new, their definitive continuation means investors must factor this into their hurdle rates for India. What does risk repricing mean? It means demanding a slightly higher expected return for holding Indian equities to compensate for this fixed tax liability. This isn't a bullish pump or bearish dump event, it's a subtle but significant adjustment to the internal rate of return calculations for sophisticated funds. It also creates a systemic headwind for any future efforts to attract highly liquid, short-term foreign capital that prioritizes tax efficiency above all else. The longer-term vulnerability lies in what we might call a subtle brain drain of capital. For domestic entrepreneurs and high-net-worth individuals, the permanent nature of these taxes could, at the margin, disincentivize certain forms of long-term equity investment or encourage them to explore alternative investment avenues, perhaps even offshore. This isn't a mass exodus, but a potential liquidity shift where some capital might seek jurisdictions with more favorable capital gains regimes. It introduces a friction point for wealth creation and retention within the domestic equity ecosystem, though strong economic growth often mitigates these effects. So, what's the forward earnings visibility and long-term multi-year thesis for India? Despite the capital gains tax confirmation, the core thesis for Indian equities remains robust. Earnings visibility for Indian corporations is strong, driven by domestic consumption, government capital expenditure, and increasing formalization of the economy. This persistent earnings growth can eventually absorb and mitigate the impact of the tax. While we might see some valuation reassessment in the short term, especially from highly tax-sensitive FIIs, the long-term structural tailwinds mean the Nifty and Sensex are likely to continue their upward trajectory, albeit with a new, permanent layer of taxation built into the expected returns. This situation underscores the importance of focusing on quality and relative strength within your portfolio. Investors should seek companies with strong pricing power, robust balance sheets, and sectors poised to benefit from India's domestic consumption story, such as financials, consumer staples, and infrastructure plays. These are the engines of the Indian economy, less susceptible to global capital shifts. This capital rotation towards domestic-facing champions can insulate your portfolio from the nuances of FII sentiment. The market appears to be pricing in a sustained period of growth, but smart positioning is now more critical than ever. So, what's the takeaway for sophisticated investors navigating this enduring policy reality? It's about acknowledging the knowns, adapting your investment framework, and focusing on the long-term structural growth drivers that remain potent. Don't chase headlines. Instead, delve into the earnings visibility and margin expansion potential of quality Indian businesses. This isn't a time for panic, but for methodical portfolio optimization. The bigger question is not if India will grow, but how you will strategically position your capital to maximize after-tax returns within its established framework. We'll continue to track these crucial developments and provide deeper dives into specific sectors and their resilience. Make sure to hit that subscribe button and turn on notifications so you don't miss our next InSTI2 analysis. Stay invested, stay informed.